Hello, everyone. I'm Katya, Senior Advisor to the board at Greenlock. Greenlock is a young but very ambitious fintech startup which is based in Switzerland. Our company helps family offices to optimize their investment fees. And we're here today with Raymond, who is a partner at TOS Advisors in the US. TOS is built for family office professionals with family office professionals. And Raymond kindly agreed to share his impressive expertise in investment fees and family offices with us today. Hi, Raymond. It's so great to have you today.
Katya, it's great to see you again. Thanks for having me.
Oh, our pleasure. Well, shall we start with the introduction?
Sure. So thanks for having me. My name's Ray D'Annunzio. I live in Houston, Texas, and work for a company that we started about 4.5 years ago called TOS Advisors. Our main mission at TOS is to really provide family office infrastructure as a service. Most of my career was spent at firms like UBS. I spent almost 2 decades there, oversaw their private wealth management division and family office division for almost 2 decades for the Western half footprint of the United States and parts of North America. And retired from there in 2016. Didn't know what else to do, but with an experienced footprint in family offices, and I was approached by some friends of ours that were in a large single family offices. We started an organization to help other family office try and optimize workflows and automate the operations of a family office. And we're certainly seeing a big trend in that now in the United States. I think we were a couple of years early, but I think we've made some headway. And we enjoy meeting firms like yours and embracing new technologies and introducing those technologies into the family offices that we work with and collaborate with. And so a big part of what we do is being very tech forward and working with emerging technology firms that we think can make a big difference for our clients. So yeah, that's what we're doing. And that's what we've been up to. It's been quite busy.
Fabulous. That would be so interesting and useful to know how is fees management covered at the MFOs and the SFOs in North America. And based on your experience, how critical is this topic?
Yeah, that's a big topic. I don't know if we have enough time for all of that, Katya,
Mhm.
but we'll give it a go.
We can always set up
It's
another session.
yeah, we can take it along. Let's start with one end of the spectrum at the single family office world. And we can even just characterize it around the ultra high net worth client segment and the family office segment. And that might be an easier way to do it. And if you think about the single family office world and some of the largest family offices, at least in North America, when you get into that top echelon of family offices, they tend to have a lot more transparency on what goes on in the market. They would be firms that look much more like asset management firms. And so in my prior life, those were the types of firms that we focused on inside of our business unit for the family office practice. Those were firms that literally were qualified as qualified institutional buyers and would have traders on staff. And so if you have traders, they should have transparency in the market when they're looking at executing from day to day. And they tend to be putting a lot more things out to bid for everything that they do. Much more professional investment management. It quickly gets quite murky. And in the single family office world, depending on who you have run your family office, the character of the family office is going to really follow who you hire. So if your first person that runs the family office is a trust lawyer, she will focus on making sure everything's in good order and everything's tight in that regard. If you hire a deal attorney, he may focus on looking at lots of different investments in sort of direct investments. If you hire a tax person, they're going to focus on bookkeeping and things in that regard. Um, if you hired me to run your family office, I would probably focus a lot on fees, because that was one of the things that I recognized when I worked at UBS, is that there's a lot of disparity around the world with what different people pay in fees at different institutions. And it's really one of those things where the squeaky wheel really does get the grease. In the multifamily office world, it also is really broad. So on one end of the family office world, what you have are an MFO that doesn't do any investment management, and they do bookkeeping and tax and act as more of your CFO on behalf of the family. In fact, for them, I'd say that for sure they think they are a fiduciary, as do most RIAs, but they don't want to cross over and get into the investment advice. For them, they think that's a conflict of interest, right? And so what they try and do really well is look after your financials like it's theirs, try and take a look at expenses, monitor what you're doing on a budget standpoint, and they do that quite well. And there's a lot of great technology that helps them do that better today. In the MFO world, that looks more like a registered investment advisory firm, I think they try and do a good job nowadays. I think they try and isolate fees as best they can. And I think that they're certainly transparent on where they charge fees for their client, right? That's almost a given in today's world because that gets isolated out from everything else that the client pays. But the problem with the rest of the system that they have to embrace is the lack of transparency around that system. So when they're doing investment vehicles like private equity or alternative investments, or when they're paying account level fees, or when they're using loan products, when they're using things like structured products, it's often really difficult to figure out what goes on inside the fee composition. If you even tried at an RIA to build a spreadsheet out and try and monitor all the different fees that you're using and having to lean into in order to execute on behalf of your clients, it's really difficult to do. You can certainly figure out and isolate quite easily what you pay in custody fees, but that's quite limited. It's everything else inside of there that is problematic for people to figure out. It's just difficult, right? And it's just not a very transparent industry. The cynic in me says that might be by design. Yeah.
Absolutely. So
Yeah.
what value could proper fees management and monitoring bring to North American clients and families?
Yeah, you're starting to see some noise in that, and you're starting to see some attention to that. And the larger and more vibrant family offices have been paying attention to this all along. Work with a really good friend of ours in New York who oversees a large family office for a Canadian family. Kevin grew up in the investment management worlds, and so he focuses on that quite extensively. The reality is, it's kind of like what John Bogle said at Vanguard: what you don't pay to somebody else, you keep. We did an analysis for a prospective client on what they were spending with all their different investment managers and custodian banks and other relationships around. And a unique characteristic of the industry, Katya, is that the longer you've been a client to most institutions, right, the more fatigued and tired your pricing is. Let me give you an example. If you and I sold a company today and we're brother and sister and we got $500 million. And so each of us split $250 million. And we decided to go speak to a lot of different firms and talk with them about what their pricing would be to do us. You and I are probably going to get shown a fee that's 20 to 25% less today, the stated fee, than someone that may have sold their business for $1 billion 10 years ago. And think about that. The person who sold their business for $1 billion 10 years ago, their money's probably grown to $1.5 billion or maybe more, depending on how they're allocated. And yet their fees are higher than what the firm is willing to offer to somebody new today. And so that's problematic. And there's no real way for a client easily to understand what they should be paying. But you really have to have some really good data points and some understanding of what someone just as you would be paying in the market today. So it's difficult, but everything's additive. When we analyze something for a prospective client of ours, and we said, look, you could probably renegotiate all your relationships with your current providers. You wouldn't have to change. In the old days, if you wanted better pricing, that meant you went from firm A to firm B, and they offered you better pricing and you moved, and then you had to experience all those frictional costs and tax effects from doing that. And in a modern environment, if you have the ability to understand where pricing should be, it's been our experience that negotiating with those institutions, it's much better for them to keep you as a client and lower your fee to something that's more modern than it is to lose you as a client, right? And so there's a lot of difficulty in understanding that as a client in the marketplace, but certainly everything in that regard drops to the bottom line. And the prospective client that we looked at had a net worth of about $580 million, and about $270 million of that was in sort of your traditional investment management at the traditional investment management firms. Our estimation was that he was probably paying $2 million a year in fees, more than he should have been paying. So it's quite eye-opening for him. It's also kind of frustrating for them, because to some degree, those fees aren't transparent. The clients don't know, and they certainly trust their advisors, as they should. You should trust the people that you work for, but oftentimes it's not up to the advisor. It's up to the firm where the pricing is.
Absolutely. Well, the benefits are so obvious, all those benefits of fees management. But why do you think this aspect has been so underestimated in the market?
Great question. I think, a lot of that is the way the industry has always operated, right? The industry in the banking industry and financial services industry has largely been operating the same way in the same platforms for 4 decades, right? So clients are comfortable using it. Oftentimes, clients don't see what they pay, which makes it difficult for everybody. And so the client's bearing that expense from their investment return always, right? They get annoyed when they see ancillary little fees from their institutions. In the United States, the retirement accounts will have a fee charged to it sometimes. There'll be transaction fees. There's certainly wiring fees. There's account level fees. There can be origination fees. There's investment management fees. Those are mostly the investment management fees transparent. But then even in the world of investment management, and it's gotten really popular in the United States for investment advisory firms and banks and broker dealers and wealth managers to use exchange traded funds, right? And so what happens when you look at an exchange traded fund, it looks an awful lot like it trades like a security. So you can buy a share of Google or you can buy an exchange traded fund, right? They trade like an individual security, but each individual exchange traded fund has a bunch of fees inside of it as well. And it can be very skinny. It can be things like the S&P 500 that has 7 basis point fee, or in some funds and some management fees, they can be up north of 100 basis points. And those fees aren't seen by people. So it's difficult to get from a granular perspective what really goes on. And then when you think about things like private equity, which is certainly, I think there's positions in the market like the Institutional Limited Partner Association that's trying to bring more transparency and uniformity to that market. But it's a market that doesn't want transparency, right? I mean, it's in the best interest of many a general partner not to have that. In that particular area, it's a very expensive asset class to participate in. It's the most expensive that you have in the market, right? Traditionally, people are paying 2% of assets under management and a 20% incentive fee to the general partner. And that can run over a certain hurdle rate. But the reality is, those are not all the fees that are inside those products. And if you ask most advisors how to help you understand those fees, they're really not equipped to figure it out themselves, right? It's not that they don't want to. We've done this experiment with many of our clients, and we've done this experience with many of our friends. We've actually given them a spreadsheet and the questions to ask, then saying, go to your provider and ask for these things. And even when the advisors would love to fill it out, they don't know where to go and how to figure it out and figure out what the fees and pricing is, right? So I think that you're seeing some change in that. You're certainly seeing people start to refocus on that. And I think that when you have big market disruptions, that makes people pay more attention to expenses, right? Whether it's because of inflation in the United States and people are spending less on vacations and doing things differently. The market's not doing really well, so they feel less wealthy. They start looking at things differently, and they start opening up to looking further at what's going on. So I think there's a desire from the consumer side to do it. I think it's difficult for everyone to really estimate what the fees are and how to look at the program and try and understand the best way to think about it. Right.
Yeah, it's a little bit unknown animal, isn't it? Even despite the value it can bring, especially if we gather all this different types of hidden fees. For example, at Greenlock, we're analyzing up to 30 different hidden fees, and yeah, when you just pull it all together, the savings are enormous. But yeah, I absolutely agree with you. It's taken quite a knowledge and experience to analyze it properly. It's a niche.
And I think that there's also, everybody focuses on return all the time, which makes sense, right? And so we focus on that, and there's less attention to fees and expenses. There seems to be attention to it when you make a decision to move to a provider. even though you don't have full transparency, you'll get a proposal and it'll tell you what the firm charges you for, what's an explicit charge that they can show you, right? But that's not all the charge in all the fees that you're paying. And then in most of the time moving forward, the attention to detail is on performance, right? It's also not that same way when you look at loan pricing. If you're a really big developer, you're going to have relationships with lots of different places to go out and try and find loans. You can go to an insurance company, you can go to a pension, you can go to a traditional bank for a conduit financing mechanism. You can hire a firm that's going to put your loan package out to bid. So every time they make a big chunky investment into something real estate wise, there's folks to help you understand and analyze that one big thing you're doing in investment wise. But compare and contrast that to most people that even have extraordinary wealth and they have relationships with places. They probably could be doing significantly better on things like their borrowing costs, right? We had a client that came to us. It was a really great family and they were working on some different things. We engaged with them and started working with them and just started mapping in all their loans, right? And that's something that people don't have their arms around. Like, pay attention to your stuff, document all of your line items, understand where everything is. We mapped in all those different things, and we actually found at one institution, the family had 3 different loans against the same collateral pool, and there was 75 basis points differential between the 3 different loans. Right. Wow. And so and it was an operational error. I don't think it was malicious, but no one had been paying attention, and this happened for years. And it wasn't until you could get the information in and look at the information and put yourself in a position to have it visible for you. So if you go into the system at a bank, or if you log into the system, sorry about that, and look at what goes on at a bank, you're not going to be able to understand necessarily everything that you're paying, right? And so it's hard to find that data. And so pulling all those documentations forward, looking at them in isolation, making everything show up, that was a differential for the client. And then we were in a position to actually go back to the institution, make them aware that there was an error, and actually have them go back in and rebate the client to the origination of the loan. Right? That institution didn't want to do it actually at the time. They said they'd rebate it back to the beginning of the year.
Oh, we should rise.
Yes, that was super kind of them. But we were like, no, it's not the client's fault that there was an operational error. And we need you to take it back to the origination of the loan and rebate that fee back to the client. And that's kind of one example, but it's difficult to get your arms around. And again, I don't believe that was anybody being sinister. I think it was just something that happened operationally. And the more wealth you have, the more complexity you tend to have nowadays, right? And so, and that can happen in things where people are very philanthropic. So they're philanthropic, and they might have a foundation, or they might, in the United States, use something like a donor advised fund. And they make their choices emotionally in the donor advised fund, but oftentimes it's overlooked what the underlying fees are to the investment vehicles for it. And honestly, for clients that embrace insurance, it's similar, because oftentimes with different insurance products that a client can use, there's underlying investment options that they can pick for that, right? We don't sell insurance, but we like to objectively help people analyze and assess and look at things and understand that fees matter. What you don't earn this year compounds. So if you saved $100,000 this year and every year on your fees, that's going to compound. And if the market grew by 10%, you have $110,000 working for you next year, compounding with your other $100,000 save plus market action. So all of that matters, and it can stand up. And when we speak to people, it's a tricky conversation. It's difficult because they trust their advisors, and that makes all the sense in the world. You do want to trust the people that you work for, but you can also verify, right? In a perfect world, you want to trust them, and you want to help them do the best job for you. Don't be 100%
Absolutely,
reliant.
yes. There's nothing wrong with increasing efficiency, and that's a perfect example of how easy it might be done with managing fees, for example. So when would you advise to start managing fees? At which stage?
Yeah, I think you need to do it all the time, right? This is sort of like it's when you buy, but it's always with maintenance too. With many things. So in the beginning, when you engage in a relationship, for certain, if you're looking at multiple different institutions or you're looking at a specific institution for something, could be a private equity investment, it could be a direct investment, it could be a real estate investment. You want to compare and contrast how that looks and how it looks differently than others in the market. And the same when you're hiring a bank or a financial advisor or a wealth management firm or an institution. Really work hard to understand everything that's going on and where all the fees are. The best advisors know this. The best advisors invest the same way that their clients do. They'll show the client their statements. The way I invest for you is the way I invest for me, right? And so it's in their best interest to know these things. But again, it's quite difficult. And then over time, you want to make certain that you're still paying attention. Certain behaviors can happen over time. Once trust is reached with an institution and a team, you've made oftentimes a very big emotional decision. Katya, you've worked with your family all your life to build this business. You've created a huge amount of money, and you need to feel comfortable about the decision that you're making. And you need to make sure that someone's interest is aligned with you moving forward. And once you do that, there's a sense of relief, I think, for a lot of people. They've made the tough decision. They've picked a firm or two, and they're working down this path. But you really still need to be paying attention. There's a lot of reasons why. Oftentimes, it's driven by objectives of an institution that you might be working with a banker, and the banker has KPIs of how they get paid every year. There's nothing wrong with that. But you need to really understand why they're making choices and selections for you and understand the economics of what they do and everything they do. And you also want to understand when you need a new service from an institution that you're still paying attention to it again. Don't just accept it as a standard that if you do business with bank ABC and you have hundreds of millions of dollars there and you're working on something and you need to do some foreign exchange component to a transaction that you're working with, you might be buying a lovely property in Aspen for $50 million and you live in Switzerland. Well, there's other costs of things that are going to happen to you throughout that transaction. Foreign exchange, your new loan rates, how things are working. And so it's easy to trust your institution and just go with them for pricing. It's smarter to understand the different components that make up that transaction and think about how you can make sure you're getting treated the best way possible. The smartest family offices and the smartest investors out there always do that. They don't take anything for granted. And by the way, those institutions work with those people. So they're used to people asking the tough questions. They're used to people pushing back, but it's uncomfortable pushing back on someone you trust, right? I mean, that's tricky. So having the information and knowing a suggestion, and when someone presents something to you, in Katya, you could say, I see this fee on here. Do I have to pay that fee? Does that fee ever get waived for anybody? There's nice ways to ask the question. And then there's the tough ways that some clients just present it to people. I'll never pay a fee like that. And if that's the way it is with you, then we're leaving your institution.
Yeah, the way of presentation matters a lot.
Yeah.
Couldn't agree
Yeah.
more.
Well,
so why don't family offices get better over time in monitoring these fees? What is the bottleneck here?
Oh my gosh, there's so many bottlenecks. And with the right information at your fingertips, you can actually just be a little bit of a velvet hammer and just say, wow, it really looks like we're paying more than we should for this. And just a conversation like that alone will have people go to work a little bit harder for you to reduce things in different areas. I think the bottleneck is it's got so many lanes in it. It's like this is like a super highway, and you're not going to believe this, but here in Houston, there's an interstate called I-10 that runs east and west. And at one point, I think it's the widest highway in the country. At one point, it's 22 lanes. And in the afternoon at rush hour, it's nothing but a parking lot, right? And if you think about all the different ways fees make it to a client, it's really in all those different lanes. And so it's hard to peel back. It's hard to understand all the different things that you should look for and that you should look at and that are examinable, right? That there are data points and you can examine them, but you have to know where to look, right? The easiest way is to say, oh, what's my advisory fee? And people think when they look at that advisory fee, that's everything that they're paying. And it's just, it's such a nominal component to everything that goes on for the client, right? So there's a lot of work to do. That's why we like your company. We think you're doing some really cool stuff. We've
Oh, thank
enjoyed
you.
engaging with you and thinking about the product and thinking about the way that the U.S. consumer could embrace these things. There's certainly a desire and a hunger for it. More and more and more throughout society, we're all wanting more transparency about everything. And I think it's certainly natural that it's going to come to this end of the market.
Yeah, these conversations could, they could be endless because honestly, the potential here is just huge. But yeah, thank you so much for sharing your very interesting insight, Raymond. I think it's super useful and very beneficial for our audience. Thank you for your time today.
Of course, look forward to continue to work with you and finding more ways to find more transparency.
Same as here. Talk to you later, Raymond. Thank you so much.
Take care.
Bye for now. Perfect.